4E, income taxes. Yum. Let's get started. First we have some definitions. Now you should have a cheat sheet referred to as the tax calculation reference sheet. These things are listed on that, and they're listed in the format of a flow chart or a formula, so to speak. You need to know each of these definitions, and you need to pay attention where you start from on the chart. If you learn how to use the chart will tell you, depending on what kind of income you're talking about, what you need to do to it to get it in the form that you need to answer the question. So first of all, if you just total the income for the entire year, that's called your gross income. So it doesn't matter where you get it from. Your everything, wages, tips, profits, capital gain, all the incoming money, that's your gross income. Now sometimes you have income that's not supposed to be taxed now, but rather taxed later when you actually get the money. That's called tax deferred income. If you have any of that, it's probably in the form of an IRA. There's other tax deferred income, but that's the most common, and we're not going to get into the kind of detail that we would if this was an accounting class, for example. But if you have tax deferred income, to go from your gross income to adjusted gross income, it's the tax deferred income that you subtract off. So any mention of an IRA or tax deferred income, to get to adjusted gross, you subtract that off. If you don't have such income, your adjusted gross income will just match your gross income. To go from adjusted gross income to taxable income, you have to subtract off what are called your exemptions and deductions. Exemptions you get per person. So in 2013, the fixed amount that you get to deduct from your income per person is $3,900. That depends on how many dependents you're claiming. The deduction part, that depends on your filing status. There's one lump sum that you get to deduct if you're single, if you're married filing separately, if you're head of household, etc. Now, some people itemize their deduction. That means they are expecting to have more to deduct from their income than the standard deduction would allow. For most people that's not true, but for some people it is. So you either take the standard deduction or you fill out a form to itemize everything you're allowed to deduct, and you only get to take one of the two. So if your itemized deductions don't add up to as much as the standard deduction, you just take the standard deduction because you want your income that you get taxed on to be lower. So if you subtract from your adjusted gross income whatever your exemptions and deductions are, the answer you get is your taxable income. Taxable income is what you use the chart at the top of your page for. Progressive income tax just means people with higher taxable incomes pay a higher tax rate. And then we're going to talk a little bit later about a tax credit. Tax credit comes straight off of your tax bill. The most common tax credit is a child tax credit, which is $1,000 off your tax bill per child that you have as a dependent. There have been other tax credits since 2003. There used to be one for helping the Katrina survivors. If you housed a Katrina evacuee, you got a tax credit for that. I think that's gone now. But the most recent one, I guess, was a tax credit for making home improvements. You can get like up to $8,000 tax credit for updating your windows and doors and such in your house to make it more insulated. But anyway, the first problem just has us go through, make sure we understand how to use the formula and what each of these things are. So the first is, how do you find gross income? That's all income. So if you read the example, Karen earned wages of $38,200 and received $750 in interest. Then she contributed and she gets exemptions, so the rest of it doesn't have to do with how much money she took in. So her gross income is her wages plus the interest, makes a total of $38,950. Second question says to find her adjusted gross income. Well, to find her adjusted gross income after you find her gross, you're looking, did she have any adjustments? Adjustments are only tax-deferred money. So it says, yeah, she contributed $1,200 to a tax-deferred retirement plan. We need to subtract that off. So if we take $38,950, subtract off $1,200, we end up with $37,750. That is her adjusted gross income. Now, she doesn't pay taxes on all that either because she gets to take off deductions and exemptions. Karen is single, so you could look in the chart. Well, it doesn't even tell you that. It just tells you apparently she's single because she gets an exemption for one person of $3,900 and deductions of $6,100, which is the standard for her filing status. So if I take the $37,750 and subtract off the deductions and exemptions, that leaves her with $27,750 that she would take to the tax tables to figure out how much taxes she owes. Sarah and Marco, they have a taxable income of $87,900, so we use the tax tables to compute the tax owed. To do that, first of all, we have to double check. We have taxable income. Yes, we do. So taxable income is what we take to the tables. When you look at the table, we want to look under married filing jointly and figure out what level do we fall into, what tax bracket do we fall into with $87,900. Well, if you look down the table, you'll see that that income goes up to the 25% bracket. That doesn't mean that we pay 25% taxes on the whole thing. We pay taxes of 10% and 15% on the portions of our income that fall into that section. Now, I will say I made a typo here, so I'm going to fix it right in front of you. Change that to 2013. Now let's go back to our slideshow here. Alright, so married filing jointly 2013, they fall into the 25% bracket, but not all of their income. Here's the way this works. 10% of their income, not 10% of their income, $17,850 worth of their income is taxed at the 10% rate for everybody who's married filing jointly. Everyone who's married filing jointly only pays 10% tax on the first $17,850 that they make. Now, they made more income than covers the 15% bracket also. So, for that portion of their income, they will only pay 15% taxes on the part that's below $72,500. But we don't pay taxes on the same income twice. So we pay taxes, 15% taxes on $72,500 worth of our income minus the $17,850 we already paid taxes on. So we have to subtract that off. Now, on the 25% bracket, I didn't make all the money that is in the 25% bracket. I only pay taxes on the money that I made. So the money that I made that falls in the 25% bracket is the $87,900. So I'm going to pay 25% tax on the $87,900 I made, minus however much I've already paid taxes on. So at this point, I've paid taxes on $72,500. Now, you can type all that into your calculator all at once as long as you're very careful about your parentheses. You really don't need the parentheses around the 10%, the 15%, the 25%. You don't have to have those. But you do have to have the ones around the income amounts. So make sure you open and close all your parentheses on the calculator correctly or you get the wrong answer. Now, some people do this problem in pieces and parts. There's not supposed to be anything wrong with that, but just strictly observation-wise, people who do it in pieces and parts instead of one big, long equation typed in tend to get it wrong. Somewhere along the line, they tend to mess up. So if I type it all in, or if I do it pieces and parts, when I combine it all together, I should have that they owe $13,832.50 in taxes. Next, Pat's head of household with a dependent child and an adjusted gross income of $57,000. He also gets $1,000 tax credit for his child, so we want to compute how much tax he owes. Alright. We are head of household with an adjusted gross income of $57,000. We don't go to the tables with $57,000. Taxable income goes to the tax table, not adjusted gross. If I have adjusted gross income, the step that I have left is I have to subtract off deductions and exemptions for Pat's filing status. So if Pat is head of household, I take $57,000 and the deduction he gets for his filing status is $89.50, and he gets 2 exemptions of $3,900, one for himself, one for the child. That leaves me with $40,250 worth of taxable income. So I go to the tables with $40,000. I keep saying that, $40,250. No matter where his income falls, he's only going to pay 10% on the first $12,750 worth. So 10% on the first $12,750. (15% tax bracket goes above his income. So he doesn't pay taxes on any money that's above his income. He only pays taxes on how much is taxable. So he pays 15% of the $40,250 that he made, minus the $12,750 he already paid taxes on. Plug that bad boy into your calculator and you should get a total of $5,400 that he owes in taxes. Tax credits come straight off your tax bill. Tax credits don't come off your income. They come off a tax bill. So if he has a $1,000 tax credit, you take $1,000 from that $5,400 he owes, and he only owes $4,400 in taxes. Now, you've got 4 problems to practice, and on the 4th one I actually asked some additional questions. So right now I'd like you to pause the video, try the first 2. The first 2 are the only 2 that'll show up on the answers first. So I'd like you to do the first 2 and then check it before you do the second 2. So hit pause. Hit pause. Here come the answers. This is the answers to the first 2 problems. Check your answers, hit pause, See if you made any mistakes, track down where you are before you go to the next slide. Please hit pause again. Hit pause, before I show you the answers for problems 3 and 4. Here's the answers to problems 3 and 4. Now, this is not the end. I'm going to ask you an additional question on problem number 4, but let's make sure that first we got it right. So again, hit pause while you check your answers. Check them at every step. If you made a mistake, see if you can find where it is. Sometimes on the math lab you get an additional question about whether or not you pay what they call a marriage penalty. They may say, do you pay a marriage benefit, or do you pay a marriage penalty or experience a marriage benefit, or is it the same? Penalty means you pay more taxes being married. Benefit means you pay less taxes by being married, and sometimes the tax rate works out the same no matter what. So if the question is, do they pay a marriage penalty or have a benefit or whatever, what you want to do is go back to the original problem and compute each person's income as if they were single. Not married filing separately, but single. If they had never gotten married, how much would each one pay in taxes? Then add that together. Add their two single people taxes together and see if they paid more as single people or if they would have paid more as married people. So please, one more time, hit pause before I show you the answers to that. When I do, say, Jessica's income first, Jessica made an income of $90,000, one deduction, one exemption, taxable income. I can do my little thing. She falls in the 25% bracket, and she owes $15,928.75 worth of taxes. Now, there's two ways this problem can unfold. Most of the time, Frank would have had a totally different income, so we would have to go through the same situation with Frank as we did with Jessica, a whole separate little figurine. In this case, though, Frank made the same amount as Jessica, so if I did Frank's income now, I would have exactly what I have all over again, which means Frank also paid $15,928.75 in taxes. So if I add Jessica's and Frank's together, I would just be doubling it. As single people, they would have paid a total of $31,857.50 in taxes. That is less than they paid as a married couple. So if you compare those two, they pay more being married than they do single. That's counterintuitive, and that rarely happens, but it did happen here. So they do pay a marriage penalty.